Want to close more deals in 2025? Well, there's only one way to do it, and that is to bridge the gap between the bid-ask spread in commercial real estate. It's your boy, Steve Peterson. Welcome to our channel where we talk all things commercial realty and investments. And, in today's video, we're going to be talking about solving the biggest problem in the commercial real estate industry in 2024 going into 2025. And that is the bid-ask spread. All right. Some of you might say, well, what is that? All right. And that is just a negotiation term for the bid, what the buyer offers, versus the ask, what the seller is asking for or what the seller wants. Right. And that's a negotiation term. But right now, it is really the biggest issue that I see in closing transactions in 2024. Right. And so that bid ask spread, that difference where sellers are at and where buyers are at, it's just a big gap right now. Right. And in order for us to close more deals, whether you're a broker, agent, investor, lender, whatever your role is in a business, if you're a transaction engineer, then you got to figure out how to close this gap, right? And this is not an easy thing to do right now because we got some real challenges. You know what I mean? Interest rates, insurance. Here in the Bay Area, we got a lot of rental laws. We got a soft rental market. All right. There's a lot high prices in general. We got a lot of things to combat, but everybody in every market is having this issue, right? So it's like, how do we deal with this? Well, the first thing we need to figure out is why is the spread so far apart? Why are buyers and sellers so far apart? When we've been seeing in commercial real estate the last year and a half, we've been seeing a lot of distress. Now, not as much distress as we saw in the great foreclosure crisis, but we are seeing distress. But we're not seeing blood on the streets distress because there's a big strategy that the lenders are using right now. It's called extend and pretend. So they are extending loans out, looking for a brighter day in the future. So they're saying, hey, look, if we foreclose on this property right now, we're probably not going to be able to sell it and get our money back. And we don't want this property on our books. So we're going to work with this borrower as best we possibly can to just extend this situation out until it gets better. It's called extend and pretend. I didn't make it up. It's an industry term. And that's what's really prevalent right now in the marketplace. So sellers who are not making money, who are losing money, who are in tough situations are working with their lenders to extend things out. And so as buyers come along and they're saying, hey, this property's in foreclosure, these private rents are down, I think I can get a great deal. A lot of sellers just aren't cutting those deals like they were in 2010 and 2011, 2009, because it's not all the way blood on the streets yet. There's a little bit of distress here, a little bit of stress there in what's in actual foreclosure, an actual bankruptcy. There's a lot more properties that are technically in default, but they're not physically in default because the lenders are working with the borrowers. So that's creating a big, gap in this bid-ask spread, right? It's a big gap. Another reason there's a huge gap is because buyers, the cost of capital, the cost that it takes a buyer to get a mortgage is ridiculous. Well, I mean, relative to where we've been in the last 5 years or so. 5 or 10 years. We were used to 4% interest rates, some 3% interest rates. And now you're looking at multifamily, all forms of commercial in the mid sixes, high sixes, and low sevens, even higher on some products. I know SBA loans, depending on what kind of product type you're getting, some are in the 8%. I've seen somebody quote 9%, thought it was hard money. Anyway, the rates are high. So as a borrower, as a buyer, you have to account for that cost of capital. And the necessary cap rate hasn't adjusted to meet that cost of capital just yet or all the way. There are deals getting done, and there's a lot more deals I saw in 2024 that happened in 2023. So there's deals getting done. There is hope, but the spread is real. And it's just because, there is distress, but sellers are holding on, and sellers are not just walking off on properties unlike in the great financial crisis, because a lot of times in those days, it was funny money. They didn't have to put much money up in order to get the loan, right? There was people doing 90% loans on apartment buildings in the Bay Area. But in this last run up, you had to really put a lot of money down. You had to put 30, 35% down. Other markets might be different, but in the Bay, you had to put that money down. So you're not just going to walk away on that, right? Like people did in the past. And then lenders learning from the past, they're going to extend the pretend, right? Buyers saying, look, if I'm going to buy this property, I got to get this interest rate. I got to make money. I'm not buying this because it's not like a house. I'm going to live in there and this is my home and my life. Nah, this is all economically driven because I got to make money. right? And there's risk, there's real risk that I got to take. So you got the sellers over here, you got the buyers over here, and there's this big gap. And those transactions don't happen unless we solve the problems that are creating this gap. And here's just a couple of ideas of how we can do this as people who, and it doesn't matter what your function is in the business, but 9 times out of 10, you probably, if you're watching this, you probably want to make some deals happen. So how do we figure this out? How do we bridge this gap, right? Well, first thing is we need to figure out what the other party, if you're a buyer, your seller, your broker, your lender, whatever it is, what do they really want? And, sellers always want more money, right? What is it that they want more money for? I'll give you an example. I'm selling a property now and we're working through this right now. So this is like a work in progress. The seller really wants to retire. He's actually carrying financing. So we've solved the financing issue for the buyer, right? Seller's carrying financing, excellent interest rate, excellent loan to value. But the price we're having an issue with because the seller wants a higher price that really the property's not worth that. Buyer's not going to overpay just because he's getting excellent financing. So I have to solve this problem. Well, what I'm telling to the seller is, what is your end goal? What are you trying to accomplish? Retirement, right? That's what he wants. So he doesn't want to have to manage the property, but he still wants to get cash flow. And I've mapped out a way where, okay, in him carrying financing, he's actually going to generate more cash flow than he is right now. The way we structure this deal as an owner, he's going to make more cash flow in the form of interest payments as a lender, seller carry, than he is as an owner. And even if he takes less of an overall amount in the price, he's going to make more in the first 3 to 5 years in cash flow that will just about equal the overall price that he wants. And so I'm showing him this because, hey, maybe you don't get the exact number you want in price, but we can accomplish the goal of retirement and we actually can significantly increase the cash flow. That's only because what he really wants is to retire. It's not about the big pile of money. It's about him moving on to the next phase of life. However, in his mind, that equals this big pile of money, So it's figuring out what the other side wants and then figuring out a creative solution, right, to delivering them what they want, right? If it's a buyer, the buyer wants cash flow or they want upside or a little bit of both. So how can they get what they want by maybe, like I'm explaining to the buyer I'm working with? Well, we might have to pay a little bit more, but you're getting financing. The seller's willing to carry it at a below market rate of interest and a higher loan to value. So while you're paying a little bit more than what you would pay if you just, cashed out completely for the property, you're actually making way more money in cash flow because that rate, we're under 1% of what the market would be. So that's a creative way of solving the problem for the buyer, solving the problem for the seller. Hopefully we get this deal closed. I'll keep y'all posted, but I just wanted to share this because a lot of my agents in my office are dealing with this. I know a lot of clients out there are dealing with this. You're probably dealing with this big bid-ask spread. How do we solve it? By figuring out what the other side wants and developing creative solutions to deliver it to them. Hope this is helpful. If it is, like, share, subscribe to the next video. Peace.